Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of GWW Grainger Inc., ticker symbol GWW. We're looking at Grainger today because they are a dividend king. Dividend kings are members of the S&P 500 who have consecutively increased their dividend payouts for each of the past 50 years. Grainger has consecutively increased their dividend payouts for 51 years now. Currently, they're paying out a dividend yield that's only 1.15%, so that's slightly below the yield of an S&P 500 ETF. However, they've got a very sustainable track record of 51 years of supporting this dividend growth. We're looking at the business in part to determine whether they'll be able to sustain this going forward. Right now, Grainger is trading for $588.06 per share. In sharp contrast to most of the rest of the market, Grainger is actually up about 16% over the last year. Over 5 years, Grainger is compounding at a rate of 21% annually. Over 10 years, they're compounding at a rate of just under 12% annually. And going back nearly 18 years prior to the global financial crisis, Grainger is compounding at a rate of 13.5% annually. Keep in mind that their dividend payouts would be in addition to this overall yield. So right now, Grainger is about $40 below their 52-week high. They're up more than $140 from their 52-week low, and just under 3% of the company's shares outstanding are currently sold short. Grainger is a large business. They have a nearly $30 billion market cap. So for more background about the business, GWW Grainger distributes 1.5 million maintenance, repair, and operating products that are sourced from over 4,500 suppliers. The company serves around 5 million customers through its online and electronic purchase platforms, vending machines, catalog distribution, and network of over 300 global branches. In recent years, Grainger has invested in its e-commerce capabilities, and it is the 11th largest e-retailer in North America. Grainger serves small and mid-sized businesses, large corporations, government entities, and other institutions. GWW Grainger Inc. was founded in 1927 and is headquartered in Lake Forest, Illinois. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Grainger based off of their business fundamentals. So this analysis is still an evolving process. It will continue to improve and get better over time, and it's an opportunity to learn in public. So with that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. Grainger earns very high returns on capital. Over this period, they've never gotten below 26% returns on capital. And in fact, over their last 12 months, they've also earned about 39% returns on capital. Averaged out, Grainger's earning just under 30% returns on capital. So that's more than twice as good as that 14% benchmark we were looking for. So this is a massive check to start off on metric number 1. The reason we're looking for that 14% benchmark is twofold. The average publicly listed business earns about a 7% return on capital, and over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these business returns are captured here by return on capital. So by looking for 14%, we could potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. In the case of Grainger, they're earning returns that are about 4 times better than that of average. Again, a massive check to start off on metric number 1. Next up, for metric number 2, here we're taking a high-level overview of the growth of the business. So we're looking for revenue growth, net income growth, and free cash flow growth over the last 5 years. This metric is all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of them is down, this entire metric will be an X. We'll also be including their last 12 months worth of numbers in our calculations here. So starting with their revenues, over this time, Grainger has grown their revenues by about 42%. They've experienced pretty stable revenue growth throughout this period. Their earnings have more than doubled, and their free cash flows are up just slightly. They're up about 12% over the last 5 years. Overall, Grainger's business is growing. This is another check on metric number 2. Next up, for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Grainger on a per share basis. So we're looking for earnings per share growth over the last 5 years. In our previous metric, we learned that their earnings are up more than double over this time frame. However, earnings are just the numerator in this earnings per share equation. So we also want to take a look at what the denominator has done, whether they've increased their shares outstanding or decreased those shares outstanding. For Grainger, fortunately for shareholders, they've decreased their shares outstanding over this period. Grainger has bought back about 12% of their shares, which again is fantastic for existing shareholders because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. So when a business buys back shares and decreases the amount of stock that they have outstanding, they're increasing your ownership percentage in the business, which is ultimately going to increase the percentage of the business's profits that you're entitled to without you having to spend a dime. So it's almost as if Grainger were making a partial acquisition of itself over this time. So just like with any other acquisition, you'd want to do the work to understand whether Grainger was getting more value for existing shareholders than the price that they were paying to buy back their shares. Regardless though, this is another check on metric number 3, and we are a perfect 3 for 3 to start things off. Next up, metric number 4 is going to be very similar. Here we're looking for free cash flow per share growth over the last 5 years. Their free cash flows were up slightly, about 12% over this time, and they bought back 12% of their shares outstanding, which means that their free cash flows per share have actually grown pretty modestly and pretty well. Over their last 12 months, Grainger has produced about $18 in cash flow per share, and so this is another check on metric number 4. It's great to see that between their buybacks and their overall growth in their business, in addition to their strong average returns on capital, that we're experiencing this strong per share growth as well, because having strong per share growth coupled with this high average return on capital is really one of the ways that a company can compound its intrinsic value per share over a long period of time. Again, to recap where we are currently, we are perfect through our first 4 metrics, 4 checks, and no X's for Grainger. Here for metric number 5, we're evaluating how the business is utilizing debt. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. So we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that Grainger has produced over the last 5 years. Grainger ended 2021 with about $2.5 billion worth of net debt. Currently, they brought this down just a little bit. Right now, they have about $2.4 billion worth of net debt. Over this time, summing up their free cash flows in all 5 of these fiscal years, Grainger has produced about $4 billion worth of free cash flow. So comparing their debt load to their abilities to produce free cash flows, it looks like Grainger is strongly cash flow generative and is able to support this modest debt load. This is another check on metric number 5, as it doesn't look like the business is excessively levered. Their free cash flows have been pretty stable for most of these years, and they've managed to grow these overall. Over their last 12 months, Grainger has brought in about $920 million worth of free cash flow. They'd be able to pay off all of their net debt with only about 3 years of their current free cash flows. Again, another check here on metric number 5, and we're perfect through our first 5 metrics. Then our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will give us a slight risk premium to the yield of the 10-year treasury and potentially give us another reason to be interested in Grainger. So we're using their total enterprise value because it's going to take into account both their market cap and their net debt position, and it's going to give us a picture of the economic reality of the business that's more similar to as if Grainger were a private company. So Grainger currently has a $32.3 billion total enterprise value, and we learned that over the last 5 years, they produced about $4 billion worth of free cash flow, meaning that in an average year, Grainger produces about $800 million worth of free cash flow. So when we divide their $800 million of their average free cash flow by their $32.3 billion total enterprise value, that gives us an average free cash flow to enterprise value yield of about 2.5%. That's coming in both shy of the yield of the 10-year treasury, and that's half of that 5% mark we're looking for. So on an average basis of their cash flows, this is an X coming in all the way at the end here on metric number 6, as this doesn't look like this would be potentially offering us that adequate risk premium we'd ideally be seeking. To get a current free cash flow to enterprise value yield for the business, over their last 12 months, we learned that Grainger has produced $920 million worth of free cash flow. So when we divide that $920 million of their last 12 months of free cash flow by their $32.3 billion total enterprise value, that gives us a 2.8% current free cash flow to enterprise value yield. So again, coming in below the yield of the 10-year treasury and far below that 5% mark as well. These select 6 metrics are simple, but when combined together, they are very powerful. Just because this is an X here doesn't mean that you're going to toss out Grainger in its entirety. It just looks like some of the high quality nature of the business that we learned about in some of these other metrics may be getting appropriately appreciated by the market currently. Then as a bonus, the main reason we're looking at Grainger today is because they are a dividend king. Again, they've consecutively increased their dividends for each of the past 51 years, and right now they're paying out a modest dividend yield of only 1.1%. So here we're looking at Grainger's dividend profile. So people make mistakes all the time by blindly chasing dividend yield or dividend track records. Instead, it's important to stop and look at the underlying fundamentals of a business to determine whether or not that dividend is going to be potentially healthy and in good shape going forward. We want a business to be able to support their dividends with either their earnings or their cash flows, depending on the type of business. And so for Grainger, we want their dividends to be well supported by their cash flows. That was the case in all 5 of these years. Grainger has never paid out more than 50% of their cash flows as dividends in any of these years, and it looks like they have a large margin to be able to comfortably support a sustainably growing dividend. It would seem like Grainger's abilities to keep increasing their dividend would be well supported into the future. Then everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Grainger, which takes us on to using a discounted cash flow model to come to a potential fair value for Grainger. A discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. Starting with their current free cash flows and projecting these out into the future using historical growth assumptions for how Grainger has managed to grow their free cash flows dating back all the way to 1990, so more than 32 years worth of data here. So it's up to you to do your own homework to determine whether or not these historical growth assumptions are going to be accurate and potentially applicable going forward to give us a baseline projected estimate for Grainger over the next 20 years, using a growth stage over the next 10 years where Grainger grows their free cash flows at a rate of about 9.5% annually, then assuming a terminal stage for the 10 years out after that, where that growth rate falls to only 6% annually. If we add in their tangible book value today and we were ideally seeking a 10% rate of return, it looks like a fair value for Grainger is around $347 per share, so that's significantly below where their current stock price is at. From today's valuations, it looks like you could reasonably expect only about a 4% rate of return going forward from Grainger, again using these same historical growth assumptions. Please keep in mind that this discount rate would also be including their dividend yield, so in reality, their stock price would likely only be appreciating by about 3% if these historical growth assumptions are accurate. There are a number of reasons why this is just an estimate, and this wouldn't be giving us the economic reality of the business going forward, one of which is potentially pricing power of the company if they grow their free cash flows at a rate that's faster than this, which again just points to the need to dig in and learn more about the business. Please be aware that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So in just a minute, we'll talk about a summary for Grainger, but we have to address something first. What are the key qualitative aspects of this business, especially those around a potential long or a potential short thesis for the company? So starting with some of the key points around a potential long thesis for the business, number one is that Grainger operates a shareholder-friendly capital allocation strategy. It has increased its dividend for 51 consecutive years and has reduced its diluted average share count by nearly 45% over the last 20 years. Number two, as a large distributor with national scale and inventory management services, Grainger is well positioned to take share from smaller regional and local distributors as customers consolidate their MRO spending. And number three, with a more sensible, transparent pricing model, Grainger should continue to gain share with existing customers and win higher margin mid-sized accounts. Then for the key points around a potential short thesis for the company, number one is a growing concentration of large customers, which are more likely to negotiate prices, could be a headwind to gross margins. Number two, Grainger is investing in its endless assortment business, which potentially goes head-to-head with e-retailers like Amazon Business. And number three, Amazon Business could disrupt the industrial distribution industry, taking margin share and pressuring Grainger's margins. So hopefully that offers a balanced perspective around some of the long and the potential short thesis for the company. Now let's jump into our summary. So in summary, Grainger checks the box on 5 out of 6 of our metrics. They're earning very high average returns on capital of nearly 30%. They've experienced growth across the board in their business, growing their revenues, earnings, and free cash flows over the last 5 years. They've also bought back 12% of their shares outstanding over this time. We also learned that relative to the cash flows the business is producing, it looks like they're using a reasonable amount of debt in their business, and that they'd be potentially able to pay off all of that debt with only 3 years worth of their current free cash flows. Our only X today came all the way at the end of our analysis for Grainger, where both on a current and an average basis, their free cash flows compared to their enterprise value were below the yield of the 10-year treasury and below the 5% benchmark we were looking for any sort of adequate risk premium. Then looking at Grainger's dividend profile, again, they're a dividend king. Grainger seems like it's very easily able to sustain its dividend going forward, and they're seemingly producing very healthy and very stable amounts of free cash flow in order to do so. Then finally, performing a discounted cash flow analysis of Grainger. If you've done the work and you believe those historical growth assumptions, then it looks like from today's valuations, you could only reasonably expect about a 4% rate of return going forward from Grainger. Again, 1% of this would be taken up by their dividend yield, so it seems reasonable that their stock price would only compound at a rate of 3% annually going forward. Again, there are a number of reasons why that might not be the case. So it's worth reiterating that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with your financial advisor. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $99. That's only 27 cents per day through my referral link down in the description below. Normally, premium is $239, but they are currently running a general offer for $119. But if you use my link, it's only $99. So check it out if you're interested. As a value investor, you ultimately want to learn about a business as if you're going to own 100% of the company, and you can truly understand the essence of that business and understand what's important and what's not important for that company going forward. Through this deeper research, you'll learn more about the qualitative and the quantitative aspects of Grainger, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of WW Grainger Inc., ticker symbol GWW. Again, we looked at the business today because they're a dividend king of 51 years. So this is another video of looking at dividend kings and dividend aristocrats, so I'm happy to make an analysis of the company. So if you enjoyed today's video or if you learned something, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Grainger with me, and have a great day.